Hello guys, in this video I'll be discussing about moving averages and we'll try to understand everything about moving average. So I'll tell you also what moving averages that I use and which is the best one to use. And I'll also tell you why sometimes the crossovers won't work and when the crossovers work and all those, everything related to moving average. And specifically, I'll focus my favorite, which is 20 EMA and also 200 EMA. I'll also discuss the crossovers and the traps and why it can be a lagging indicator sometimes, and all those we can discuss, and how you combine moving averages with other indicators so that you can get better, accurate entry, how you can increase the probability is what we are going to discuss. See, I've seen most of the traders, they believe that moving average help to predict the market direction, right? And what I've seen is many people think that, even from my videos also, I think this is how it is misunderstood, right? Moving averages tell when to buy. It's like when you are seeing the prices coming and touching moving average, immediately you will buy. No, it's nothing like that. I'll be talking about that also. And moving averages is not telling you when to buy, when to sell. It is giving you a potential area, a best average price. As its name indicate, it's average. It's a mean, right? So it is talking about mean reversion. It is talking about mean price. It is talking about average price, rather than buying at the very higher level or waiting for a lower level. It is always better to buy at a mean price, an average price. So that is actually the use of moving average. I'll talk about that also. I'll talk about the golden cross and death cross, how that is going to create an edge. At the same time, how these crossovers can trap you also, with enough examples, right? See, again, if you see golden cross, death cross, then you think that death cross is going to give you 1,000 point move on the downside and etc. That belief is actually responsible for significant percent of trading losses. So how the moving average work, how the crossovers work, how it can trap you, let's try to understand everything. So see, the problem is how you're going to use it. I'm not saying moving average itself is a problem, right? You have to use it, and if you're not using moving average, you're not a trader. You have to use it, but the way you use it may have to change, because you need to understand the science behind it. So moving average is not decided or designed to predict the future. It is actually designed to reveal something much more important. See, that is nothing but the line of least resistance. So let's try to understand this single concept of the line of least resistance. It can completely change how you look at the chart and the trends, and how you capture the trend, how you wait for the pullback, and how you not get trapped in the breakouts and always wait for your price to come close to your moving average. That is the line of least resistance. So see, the biggest problem that many people make, the beginners especially, they walk into any trading room, or any trading forum, or any telegram channels, or watch YouTube channels, and then you see some kind of approach which is used by with moving average. The common method is you have a 50 EMA or 200 EMA. In the beginning, you may use moving average, simple MA, right? Simple moving average, SMA, or you wait for golden cross. And if it is a golden cross, that is 200 EMA and 50 EMA. When you see a crossover on the upside, 50 crossing over 200 EMA, it's a golden cross, you will buy, and then wait for the death cross. That means 50 crossing over the 200 on the downside, you will sell. And majority of you believe that this is a complete trading system. But in reality, if you look at the crossovers, these are lagging signals. These are late entries. The move is over, that's when you get the cross. And if you get the cross, you have to wait for a pullback to enter, right? By the time the crossover occur, the trend has already started and the trend has overextended. Now it is time for a healthy pullback. So if you enter when you see the crossover, you are giving exits to someone, you are giving some others an opportunity to book their profit, and you are entering at a higher price, and it give a healthy pullback, and from there it bounce also. But by the time it comes to that level where you are supposed to buy, your stop loss is crossing the limit, and then you will have to exit. And by the time you exit, price will come to the better level and it start bounce and it will resume the trend and you are out of it, but the price will move. So that is why always wait. So see, the issue with crossover is very simple. The trend has already started or in the midway. Sometimes the move is already near to its completion also. Now think about this. Why this moving average crossover fail? See, it worked poorly, especially in sideways market. And markets spend large portion of their life in consolidation, ranging, and moving sideways. If you look at the last couple of weeks where the market is in a very tight range, right? And in these kind of environment, you get the crossover, and these crossovers generate only false signal, and the traders get whipsawed repeatedly. You see a golden crossover, you see a death crossover, you take an entry on the upside, you get trapped and you take a stop loss, and you get a downside move also, you get a stop loss. So you get whipsawed both the sides, and accounts slowly bleed also, and you will see maximum drawdowns during this period if you try to chase the crossovers. Market doesn't care about your indicators. Many traders believe that price respect the moving average. Moving average act as support, moving average act as resistance. But the market does not care what indicators are there in your chart. The market only follow one principle, that is the path of least resistance. That's what I told you in the beginning. Price naturally move towards the direction where the resistance is the lowest. So you look at that area where the resistance is the lowest, price moves there, right? Or price start moving from there where you get the support. So understanding that path, that is the real purpose of moving average. So moving average should be understood in this way to understand the path of least resistance. So moving average is not a predictor. Moving average will tell you what already happened, because it's the average of last 20 candles. If you take 20 moving average, if you take 200, it's the average of last 20 candles. It does not tell you what can happen next. It is essentially a rear view mirror, not a crystal ball through which you can see or the predict the future. So what is this line of least resistance? See, market trend because buying pressure exceeds selling pressure. Market trend upside because buying pressure, buying pressure is more than the selling pressure, or buyers are more than the sellers, or demand is more than the supply. Market trend downside when selling pressure exceeds buying pressure. The supply is more than the demand, or sellers are more than the buyers. Now, once that imbalance develop, right, then the trends tend to continue. So if there is a balance, the buyers and sellers are almost equal. Buyers and sellers are fighting equally. Then what happen? You will buy, someone else will sell. Buy, sell. So that going sideways. But if buying exceed selling, higher demand, it keeps going one side. That keeps a market trend upside. So market tend to trend upside, and market tend to continue the trend on the upside. Similarly, if selling is more than buying, means it keeps going down. If these are equal, or if these are balanced, then it will go sideways. If there is imbalance created between demand supply. So what is a trending market? Trending market is ultimately an imbalance between buying and selling. It is an imbalance between demand and supply. It is an imbalance between sellers and buyers. The moment buyers will be higher than the sellers, it trend upward. The moment sellers higher than buyers, it trend downward. The moment there is a balance between buyers and sellers, market go in a consolidation phase, right? Until a large force interrupt them. And that direction is what we call as the line of least resistance. So everything in trading should focus on identifying these lines. Where is this imbalance is happening? Where the buyers exceed sellers, where the sellers exceed buyers, right? So what is the real purpose of moving average then? The moving average simply is a visual representation of a trend direction, nothing more. If the price is above moving average, it's an uptrend. If the price is below moving average, it's a downtrend. Again, it changed based on the time frame that you have chosen, right? So again, change based on the number of candles that you have chosen. I mean, 20 EMA means 20 candle, 200 EMA means 200 candles. That also depending upon 5-minute, 3-minute, 1 hour time frames, nothing else. So what is moving average actually showing? Now, how many of you understood this? The moving average is basically the closing price over a specific period, right? So if I'm talking about 20 moving average, what is it showing? That line, what is that? Let me show you. So you can see this is let's say this is a moving average, right? Now it is coming to this, and you can see there is a good rejection is also coming. So if I place what is this actually is about? This is nothing but the closing price of last 20 moving averages. What is this? This is the closing price of last 9 moving averages. This is 9 EMA. What is this? This is the closing price of average of last 200 moving averages. So that is what you will understand. It is based on what actually happened before. Now, the very simple rule is if moving average slopes up, it means buyers are paying higher prices. Buyers are dominating and sellers are demanding higher prices, right? So that means the consensus price is rising. Therefore, the path of least resistance is up. Okay, if the what I said is if moving average slopes up. Now, on the contrary, if moving average slopes down, as you see here, let me show you. I mean, if you can connect it, it's slightly scientific in that way. This is very clearly moving average slopes down. Now, what does this mean? Consensus prices now falling, right? What does that mean? The path of least resistance is down. So if moving average is indicating upside, for example, if this is sloping upside, so here moving average is sloping upside. What does that mean? Buyers are more, sellers are less, and buyers are paying higher price and sellers are demanding higher price. So here the path of least resistance, that's what I mean by here the consensus price is actually rising. That is what moving average is showing upside. The consensus price is rising. Here the consensus price is falling. So the path of least resistance is down. The path of least resistance is up. Now what if the moving average is flat? Sometimes you'll see like this. There's a kind of flat moving average. This is from here it is a flat moving average. In that case, there is no such consent. The path of least resistance is nothing, right? No clear direction, no clear trend. Buyers and sellers are equally present. Buyers and sellers are equally strong. Buyers and sellers are equally no one is dominating, right? So only noise is existing at that level. So three state of the market. There are only three state of the market. There is no fourth state exist. Either it's a bullish environment when the moving average slopes up, or bearish environment when the moving average slopes down, or moving average is going sideways. That is, there is no trend. So bullish environment means moving average slope upward, price will be above moving average. So very clearly, moving average, firstly, there should be a slope. Secondly, price is above moving average. And here, line of least resistance that I've discussed is up. Buyers are willing to pay more price, sellers are demanding more price also. So you need to look only for long opportunity. Very simple. When slope is there on the upside, price is above the moving averages, you look only for long opportunities. That is why you always say, let the price come above 20 MA, I look on the upside. Let the price come below 20 MA, I look at the downside. These, if you have observed my live sessions, you might have heard this, right? So when the slope is on the upside, let me show you again. So when the slope is on the upside and when the price is also above that moving average, then you look for only long opportunity when it comes close to the EMA. When the price crosses this level or when the slope is gone, then ignore this, right? And when the price is above the moving average sloping upside, avoid short trade setup also. Now, when you will look for short trade setup, the price tends or slopes on the downside and price below the average, coming close to the moving averages, you look for downside move. Okay, so this is a bearish environment. Moving average is sloping downward and the price is below moving average. So line of least resistance is down here and you look for only short opportunities anywhere near your EMA. And here, try to avoid buying the dips. Don't think that I can buy the dips and I can capture big move. Avoid this. If you want to, let them cross this 20, let the price come above that first. Slope, okay, that can be secondary, but let at least the price come above. Then only you'll get momentum, especially as an option buyer. So I hope you got that idea. Then there is a third state that is no move at all. The moving average is flat. Price crossing above and below the moving average repeatedly. One candle cross, one candle come down, one candle goes up, one candle come down. So here there is no line of least resistance. So what is the action here? Do nothing. Just wait. Preserve your capital. Protect your capital when move is on the sideways, or all the candles are touching the EMAs, 20 EMA or 50 EMA, or crossing on upside, crossing on downside like this. Now, which moving average should be used? Most traders are obsessed with 20, 50, 100, 200. But a lot of noise also will come. So to avoid that, I keep 20 and 200 in my screen, and at the same time 9 EMA for my stop losses. See, any moving average work, right? 50 and 200, if you take any moving average in between, generally reveal the same trend only and same direction only. But what I use is 20 and 200. But 100 EMA, there are many of my mentees, they are using it. It is working properly. But 20 and 200 is what my personal favorite. But again, depending upon the instrument that you trade, right? If you're trading in stocks, it's different. But if you're trading in index, 20 and 200 will give you beautiful moves. Then that's enough. So 100 EMA on daily chart, you can use only for determining the trend direction, not for your entries, not for exits, not for reversal, only for getting the direction. 100. But 20, you can take that entry also on the short if you get that, pullbacks. So 20 EMA is what I look for pullback entries. And remember, slope is very important. Slope determines the direction. If moving average is sloping upward, you only look for long trades. If moving average slope downward, only short trade. This is the most important point that you have to take from here. If moving average is flat, don't even trade. If it is upside sloping, trade upside. If it is downside sloping, trade downside. Never ever violate this rule. This is the most important rule that you need to follow. And moving average is a filter. The moving average is not an entry signal. Right, a touch of moving average or a bounce of moving average or a rejection of moving average. None of these are actually automatically creating a trade as such. The moving average is simply telling you which direction to look at it. But close to moving average, you get better average price because you're not goad to enter at a lower price and sell at a higher price. It is always better to enter at an average price, which will be guided by the moving average. But entry actually should come from price action. Of course, the trigger is there. Look at the important pivot points. If the important pivot points are breaking in an uptrend, when price breaks previous swing high. In downtrend, if the price is breaking previous swing low. For example, if you look at this one, I'll show you. Today, this low, once this strong candle is taken out this level, then retracement to moving average, giving you the best trade. Right? So you get a better price, a better range also, better price also, you get the direction also. So I want to trade in this direction, but I get more clarity when they broke this low with this strong candle. Either I can enter immediately or I can wait for a pullback to enter. So that is why here you will get a better trade. Sometimes it can go further down immediately and you may miss also, but waiting for pullback will always work better. Right? So in an uptrend, if you're looking for a upside trade, wait for a previous swing high to break out. Or if you're looking for a downside trade, here the price is down, wait for the previous swing low to break. Then you will enter. Now, why this matter? Why this is important? See, when we talk about a breakout above a swing high or a breakdown below a swing low, here what is happening when the breakdown below this low? What is actually happening is here the sellers have defeated the buyers. Right? And there was a clear downside trend here, which is coming, and you got a pullback. And now there is what they are going to do is they are going to resume this downtrend. So buyers made an attempt. Now they are breaking that low. That means the buyers are clearly defeated by the sellers and the momentum on the downside is coming back. So you should be trading when this low is broken. Similarly, upside also, when a swing high is taken out means what? Buyers are defeating the sellers. So the trend again on the upside is going to resume. So the momentum will return back. We'll be trading on the upside in that case. So see, actually the trend should pay for you. And most traders actually exit too early. Instead, you have to remain in the trade till the time the price stays on the correct side of EMA. And as long as the slope is favorable to you. The moment you see that slope is slightly changing, that is when you can, or you keep a smaller EMA, like 5 EMA or 9 EMA. When the price comes above that, or if I'm making an entry and following 5-minute 20 EMA, then if crossing 3-minute 20 EMA also you can exit. That way you can plan. or when you see that EMA is getting flatter, or you see the price is reversing. Exit only when price close decisively on the wrong side. Any short-term moving averages or the slope changing the direction. Otherwise, let it run. That is how you get the bigger. I'm not talking about scalping. I'm not option scalping. I do with 10, 15, 20, 30 points also. That is an entirely different case. Now, very important to understand the pivotal point. Now, what do you mean by CPRs and the pivots? These are pivotal points, important turning points, important swing levels. So that is the last important resistance in an uptrend or the last important support in a downtrend. These are the major pivotal point. For example, now the price is 23,300, 23,200 is one of the major pivotal level. 23,000, 22,800. What is the recent swing low? That, right? So for example, in a bullish scenario, 100 EMA is suppose sloping upward, or 200 EMA. I'm talking about 100 because that is what generally people use in international community, right? And 100 EMA sloping upward. Here I have placed 200 EMA. For me, 200 EMA sloping upward, and price is above that. So bullish example, right? Now, the recent swing high, you might have seen the recent swing high and wait for the breakout. And only after the breakout, you will enter. Now, after breakout, you will enter immediately, or you wait for a retracement to 20 EMA and you will enter. Similarly, if I need to give a bearish example, this very clearly tell you bearish example. As I told you, it is 100 EMA, but in my chart, it is 200 EMA. What I am comfortable in my index trading is 200 EMA. So 200 EMA is downside, right? Now the price is below 20 EMA, and this is a swing low that I'm talking about. Broken that low. Now either I can enter here, or I'll wait for a pullback to 20 EMA so that I get a better average price and I enter there. So this is how you'll make your entry. Perfect. That's the bearish example. Now the question is, if this is the case, why most of the traders are failing? The problem is not the system. The problem is individual. The problem is psychology. You will see a lot of emotional reaction, right? Many of you may think that what if this is false? What if market crash tomorrow? What if I'm buying at the top? So the hesitation start, the FOMO will start, or you enter early because of FOMO. You want exit when you get profit because of greed. You exit faster because of fear, right? And this hesitation, because of that opportunity, you miss also. And if you entered, even if price pull back slightly, you're afraid. You think that I have to protect my profit, better to book the profits faster. And then you exit and the market continue moving for, for months also in the trend. I'm talking about if you are buying stocks or something. So the real battle is not you versus market. When it comes to, this is what I always tell, if you're strong mentally, then only you will be successful in trading. The real battle is you and you versus yourself, not you with some others. Enough liquidity is there, no one care who you are, whether you exist or not, with your 1 lakh or 20 lakh, no one care. Markets are traded with, yesterday that move, if you see, that was 1.5 billion. Can you imagine? In a matter of 5 minutes, 10 minutes, 1.5 billion is the volume was traded. So the question is not, or the battle is not between you and market. It is between you and yourself. And the enemies here, fear, greed, impatience, and that, what to say, that you're adamant that you need to be right. You cannot be right always. You're playing with probability game, right? So what should be the complete method? If the 200 EMA is flat, if your 20 EMA is flat, no trade, just wait. If your 200 EMA is sloping upward, or 100 EMA, if you are looking for some other index, this 200 EMA, 100 EMA is turning upward, price above that, trend is confirmed, upside trend, right? And you can look for upside trade, or price is consolidating and you see a box or a range is forming. And then in that upper boundary, that becomes a pivotal point that need to be broken, right? And price break above that pivot and you get a strong close above that, your entry will be triggered. But it's better to wait for a pullback also, even in that case as well. What is the next step? The price retrace. It comes close to that EMA. And most traders panic, but professional traders, that is where you will average or you will buy. Trend remain intact. as long as it is breaking on the downside. And trend can continue for days and months also. Intraday basis, that is different. So eventually, price close below EMA or the slope flattens, then only the trend is over. That is when you need to exit if you are in a long-term trade. So the entire strategy, if I need to give in one line, moving average will identify the trend. Pivotal points provides your entry, breakouts, breakdowns, and the trend determines your exit if it is going flat or if it is reversing. That's it. No magic, no prediction, no complicated indicators. See, always remember the market does not reward intelligence. I've seen many intelligent, I have seen the brightest of the bright minds of the country. Market also won't reward your hard work. You study howsoever, no matter what, market is going to be brutal. Not going to reward more indicators or better software. Market reward what? Being on the correct side of the line of least resistance and staying there long enough that help you to make wealth. I mean, real wealth. So the moving average is not a magic wall. It just give you the direction. It's not a reversal predictor. There is no such crossover system. It's a trend filter. It gives you the direction and a visual representation of the line of least resistance. And the biggest money in trading is not made in buying or selling. The biggest money is made in waiting for the right trend, waiting for the right breakout, and spotting that correct opportunity. And then having the discipline to stay with the move until the market itself tell you it's over. There's a real secret behind successful use of moving average, nothing else. So I hope you got some value from the session. I see you in the next video. If you would like to join us for our live market mentoring session, get in touch with us. See you there.